Good morning and welcome to Multitude's H1 2025 earnings call. My name is Adam Hansson-Tømming. I'm the Head of Investor Relations and Treasury at Multitude since May this year. Prior to that, I've been with Multitude for 15 years this year, most recently as Head of FP&A, and I will be your host today. Joining us to present the H1 results today is Antti Kumpulainen, CEO of Multitude, and Bernd Egger, CFO of Multitude. After the presentation, there will be a Q&A session where you can raise questions either through chat by using the Q&A box at the bottom of your screen, or via voice by raising your hand using a button also located at the bottom of your screen. With that, I'll leave the word over to the CEO of Multitude, Antti Kumpulainen.
Good morning, everyone. My name is Antti Kumpulainen and I'm the CEO of Multitude Group. During this call, I will walk you through Multitude's earnings call and results for the first half of 2025 with our CFO, Mr. Bernd Egger. The first half of year 2025 has been amazing as we continued on a really good path into the second quarter. To remind you all, we did just adjust our net profit guidance after the great first quarter, and we are keeping that guidance. Today, we want to share with you some key takeaways from the first half of the year. First, our revenue continued to grow by 3.5% to 133.4 million euros. Second, we delivered again a strong net profit, which increased by 93.6% to 14 million euros. Third, impairment losses on loans decreased by over 18.6% year on year. And fourth, we increased our stake in Lea Bank to a total stake of 24.99%. And fifth, we are further streamlining and simplifying our structures, and we are reducing the number of legal entities by 1/3 during the year 2025. Okay, we can go to the next page. I would like to recap briefly who we are, where we come from, and more importantly, where we are going on our way. We were founded in Finland in 2005. Our registered seat is in Switzerland. We operate with the full EU-wide banking license, and we are listed on the Frankfurt Stock Exchange in the Prime Standard. During our 20-year journey, we have built a solid track record as a profitable global FinTech company, delivering an outstanding and fully digital customer experience focused on serving customers often overlooked by traditional banks. Next page. Since the beginning of our company, we have always strived to build and offer services to customers who are overlooked by traditional banks. Our vision is to build the most valuable financial platform for them. We believe this can be achieved by offering an amazing customer experience that's digital, fast, easy, and a green choice. We have built our FinTech growth platform to serve as the core with scalable components hosting these business units. The platform currently serves our 3 business units: consumer banking with Ferratum brand, business banking CapitalBox, which focuses on digital SME banking, and our newest business unit, wholesale banking, with Multitude Bank brand. Our focus on the platform is to enhance scalability and constantly seek and be ready for new opportunities. Our company has from the very beginning aimed to grow profitably and follow ESG principles. We are confident in our business model, which we have proved by delivering our profit targets consistently year after year, and also recently increased our profit guidance for year 2025. We are committed to our high dividend payout ratio, a target of between 25% to 50% of annual net profit. From last year's profit, we paid out a total dividend of 44 cents per share, being more than 46% of the net profit. Out of this, 20 cents was a base dividend and 24 cents an extraordinary dividend. We are continuing to follow our dream in building a company valued at 1 billion euros by end of year 2028. Okay, then we are ready to take a closer look into the performance of Multitude in the first half of 2025, which showed again strong net profit growth and further improved asset quality. We have been able to continue our growth in the market and our work of simplifying and streamlining the operations and companies starting to bear fruit. Revenue grew by 3.5% to 133.4 million euros, and our net profit increased by an impressive 95.2% to 14.2 million. A major driver was our continued good control of impairment losses, which decreased by 18.6% or almost by 10 million year-on-year. This is thanks to our robust business model and high-performing teams, and we have seen this trend already for a long time. We are still in the process of restructuring and streamlining the company and organization, which might have an impact on some financial metrics going forward. We, for instance, are planning to reduce the number of legal entities in the Multitude Group by 1/3 during this year. Each of our business units are in different life cycle, and each one is contributing to these results. Our investment in Lea Bank shares has continued, and our stake has increased to 24.99%, and we are the largest shareholder in Lea Bank. We continue to explore and prepare the strategic cooperation between the companies. Going forward, we have a really clear focus. We are focusing on growing our business through our 3 pillars: organic growth, partnerships, and through M&A. Further, to digitalize and automate our operations with extensive use of AI and data. Maintain high asset quality. We are also focusing on achieving our net profit guidance, which is between 24 to 26 million euros in 2025 and 30 million euros in 2026. Okay, let's go more deeply now into our business units, and we will start with consumer banking, Ferratum. Profitability increased in the first half significantly by 16.5%. Asset quality is still improving, which was a big contributor to the increase in EBT. Revenue was kept roughly at the same level year-on-year. Portfolio and size of net AR kept on growing with more than 9% year-on-year. Mentionable from the product side is the successful rollout of credit cards in the German market. Target for this year, 2025, is an EBT growth of 5%, and we are in a good pace for that, as you can see. Focus for Ferratum is on high profit margin markets, growth through partnerships, and M&A opportunities. Streamlining of operations, scalability, and continuing the increase of automation and extensive usage of data, and rolling out AI are, of course, in the core of our activities. Let's jump to our business banking unit, CapitalBox. Revenue growth continued with high single-digit and portfolio growth in double-digit numbers in H1. The achievement I want to specifically highlight is the massive improvement in EBT that the team has been able to deliver. Even though CapitalBox was still loss-making in H1, the losses were reduced by a whopping 77% or almost 5 million euros compared to the first half of last year. Our target for 2025 is being profitable on a quarterly basis in the second half of the year. Asset quality continued improving, and it led to a decrease in impairments by 38.6% compared to the first half of last year. Factoring product was launched both in Finland and the Netherlands, with AI-driven solutions running in the core of the processes. Also, a big milestone was the successful launch of the secure lending offering for our customers in the Danish market. Focus for CapitalBox going forward is to continue improving profitability without sacrificing growth. Increased use of AI, automation, and utilizing data even more than today are the cornerstones of scaling the business and in a profitable way. Target for the full year, like said, is to deliver double-digit growth and to be profitable on a quarterly basis in the second half. Then finally, our newest business unit, wholesale banking, which is growing fast. Growth has been really strong, and asset quality remains strong thanks to carefully selected customers. Revenue growth was almost 86%, and net AR grew by over 90% in the first half of the year. We do also see a positive EBT in H1. Payment services are growing the fee-based revenue side of the business, and we expect more payment institutions to be added as clients during the second half of the year. The team is now focusing on closing the secure debt pipeline, which is really strong. Same goes for the payment services. Focus is also in improving the scalability through further usage of data, AI, and automating the processes further, whilst keeping the risks in really good control. Target of reaching EBT of 4 to 5 million euros for 2025 is intact. Now I'm ready to hand over to Bernd, who will tell you about the financial performance for the first half of the year. all yours, Bernd.
Thank you, Antti. Good morning to you all. Thank you very much for your interest in Multitude's earnings call covering H1 results. I think the first 6 months can be characterized as really convincing as regards to performance, especially when it comes to profitability metrics. These continue to be great. Driving forces behind this excellent development were solid growth dynamics, when we will look into the specifics on a tribe level a little bit later. Continued improvement in credit risk management, super important to us. And thirdly, the scalability of the organization. Let's start with P&L and go into more detail. Key message number one that I would like to bring across, we still have robust overall growth dynamics, and we will look into the drivers on a segment level. What I like really a lot about the H1 result in terms of monetization is that for the first time we have incurred quite meaningful fee income. So 5.4 million H1 this year compared to a little bit more than 20,000 last year. So from a strategic perspective, from a monetization perspective, and hopefully at some point also from a valuation perspective, this is really a very important key message I would like to bring across. Secondly, the actions taken to improve credit risk performance over the last couple of quarters are yielding very strong results. This means that a very positive trend that we have initiated some 1.5 years is being continued. We will also here analyze on a consolidated and on a business unit level, but this is definitely a key message that deserves a lot of attention, almost -20% in credit losses in absolute terms. Message number 3, the organization is scalable, and at the same time we want to invest in growth. So these two factors, efficiency on the one hand side and growth on the other, determine cost development going forward. Now let's go into more detail on the financial performance metrics and start with revenue. Interest income essentially on the same level as last year, 128 million, and at the same time, as pointed out, a very significant increase in fee income. Fee income plus interest income taken together, 133 million, to be precise, 133.4, so an increase by 3.5% compared to last year. The key drivers behind this increase in fee income is twofold. On the one hand side, that's partner business in consumer banking, and on the other hand side, that's payment business in wholesale banking. We'll come to the specific numbers. Both monetization models are 100% in line with our platform approach and with the partnership strategy that we had communicated. Interest expense and net interest income. Interest expense increased compared to H1 level by around about 3 million. This is essentially driven by two factors. One, volume has increased quite significantly. And secondly, we have successfully, I would like to add, placed for the first time a meaningful regulatory capital instrument on the level of the bank, Multitude Bank, a 25 million Tier 2 instrument in H1, specifically in Q1. At the same time, we see that gradually interest expenses are decreasing, and weighted average cost of debt funding is going down a little bit, which is offsetting the volume increase. Naturally, we want to push down interest expense also going forward. Compared to H2 24, we see around about 0.5 million lower interest expenses already. Taking those factors together gets us to net interest income of 106.3 million, which compares to 110 million last year, a slight drop. However, if we factor in the pro rata profit share that we now are incurring from our associates, 1 million roundabout in H1, we get to a net operating income of 110.6 million, a slight increase by 1.4 million compared to last year. This 1 million to establish the bridge to what Antti has just said is mainly driven by Lea Bank. Let me move on to the second key message, credit loss performance, which is and has been one of the top priorities for the full year 24 and for H1 2025. Obviously, this is a very decisive factor behind our profitability boost, and credit risk performance has improved very significantly. Credit loss is down in H1 25 from 52 million to 42 million, 42.4, which is a drop by almost 10 million, 9.7 million, or 19% compared to last year. We will go into a little bit more detail on credit losses on a segment level when we discuss segment performance. The third key message that I've put at the beginning is scalability of the organization. We want to balance growth and efficiency. Personnel expenses increasing slightly by 5% to 19.8 million. Two key drivers, essentially, we are teaming up. We are adding some resources when it comes to our ability to foster and accelerate growth in the new businesses. And secondly, as performance is really good, a slight increase in accruals for variable compensation. Operational expenses, general and admin expenses for H1 at 19 million, which is 2.5 million above last year. Key drivers are strategic projects, quite a number of initiatives, increasing audit expenses, whether we like it or not. That is just something, regulatory complexity, some of them of one-off nature related to relocation to Switzerland. And finally, the key driver behind general and admin expense by a little bit more than 45% is driven by depositor compensation scheme. So this is a function of growth in the end. Depreciation expenses, marketing, other expenses, de facto flat. In fact, slightly below last year's level, some minus 100K. And overall, as pointed out, our ambition remains to accelerate our efficiency programs and at the same time invest in future growth. If we move on and take a look at the financial performance in terms of profitability, I'm still on the P&L slide, taking into consideration all those three factors: revenue development, credit loss performance, cost development. This gets us to profit before tax of more than 16 million, 16.3 million, almost doubling compared to last year. H1 24, 7.9 million, an increase by 94%. With a effective tax rate that remains constant at 13%, this gets us to a net profit of 14.2 million. And again, this is almost doubling compared to last year, plus 95%. So really great, especially as this performance in Q2 confirms and repeats the strong performance and the very high net profit levels that we have seen in Q4 24, in Q1 25, and now also in Q2 2025. Let's now move on to balance sheet. I think there are 2 or 3 key messages I want to bring across. Cash, that is all good, plus 28 million, which has to do with deposit increase and also with the successful placement of the financial instrument on regulatory instrument on the level of the bank, plus of course cash generated by the business. Loans and investment portfolio in its entirety up 90 million. Other financial assets, maybe something that I would like to highlight briefly, from 27 million to 50 million. That has to do with strategic partnerships, receivables from portfolio sales, and effect of businesses sold, as pointed out by Antti. Overall, the ambition has been for this year and will also be for the remainder of the year that we reduce the number of legal entities by 1/3 this year. Finally, talking about the assets, around 20 million investment in associates. This is also considerably higher level than last year. Key driver here behind this investment number is the investment in Lehrbank, 24.99%. On the next slide, equity and liability. Equity up to close to 196 million. In terms of liability, nothing beyond what I've said already. Deposits, main source of funding, increased to 927 million. Tier 2 transaction, I've highlighted this already. Let's take a look on the next slide on segment performance. I will start, as always, with consumer banking, and Ferratum makes it quite easy for me to take a deeper look at their performance. In short, Ferratum has again performed exceptionally well, especially in terms of profitability. Revenue is de facto on the same level as last year, down by 1 million, 1.1 million, that's 1%. Roughly, but the positive aspect is really that we are generating very meaningful fee income, 4.3 million in the Ferratum business. So really an excellent development and a 100% confirmation of, I would say, the appropriateness of the strategy of the Ferratum team. In terms of credit losses, again, and we have a summary slide on the next page, but let's stick on this one for a second. Now, for a number of quarters in a row, really strong performance. I've updated you in Q1 that we had an exceptionally low credit loss level of 19.1 million in Q1, which is actually, or was actually, below the already strong Q2 to Q4 performance last year. Now we are even lower by another 2 million, 17 million credit losses in the Ferratum business in Q2. And this gets us, for the combined view on H1, minus 18% compared to last year. OpEx very well under control. Profit before tax from already extremely strong 15 million to 17.4 million. So plus another 2.5 million or 16.5% from an already extremely strong level in H1 2024. So in short, very impressive performance, focus on leaner organization, focus on pushing products that incur recurring revenues. These are that's the way forward for the consumer business. Now, CapitalBox, as the second one, we are quite satisfied with top line development. So revenue increasing by around about 8% to 17.3, which is an all-time high on a semi-annual basis. Credit losses also deserves, I think, quite positive recognition. As a recap, credit losses were a little bit elevated in 2024, now down by 39% compared to last year. So H1, we are now at 4.9 million credit losses. Last year, we were at 8 million, so almost 40% drop, despite the fact that the portfolio now is around about 20 million larger than last year. So this is a great success. Naturally, credit losses will remain a focus area. Cost. The CapitalBox team has done a lot to streamline the organization following the integration of the acquired Danish Omnivet, the factoring business, and following also a number of efficiency initiatives. OpEx is on a lower level than last year, despite the fact that the business is growing minus 10% to 9.7 million. So that's really good. And as a consequence of higher revenues, strongly reduced credit losses and lower cost levels, we see still a slight negative, but only 1.5 million negative profit before tax contribution. And as pointed out, 77% reduction in losses. The ambition still is for Q3 or Q4 to see profit contribution, positive profit contribution on a quarterly level from the CapitalBox business. Wholesale banking also makes it pretty easy to find quite attractive and positive words. I would say revenue up to almost 10 million, an increase by 4.5 million. So 2/3, 65% increase. Plus, and again, this monetarization element is something I like a lot. Incremental fee income, 1.1 million from newly established payment business. So that's the addition to the 4.3 million fee income incurred by the Ferratum business. Credit loss performance, we have now started building up some reserves. This is why we see some 1.3, 1.4 million in H1, but that is more a conservative approach. The businesses are performing well, so that is all very well on track. Cost structure, naturally, as an early stage business, still personal expenses and operational expenses are increasing by slightly above 1/3, but at a degressive rate. And that makes us quite optimistic that the very ambitious target of achieving 4 million, a little bit more than 4 million profit before tax on a full year basis is something that we can achieve. Let's now take a look at the next two slides on credit losses and asset quality. Here, I will not go into too much detail. Maybe you want to focus on the black bars that reflects the continued reduction of credit losses on a tribe level. Going forward, we will also present the wholesale banking business here, but the key message is we are continuing to reduce credit losses in all businesses. On the next slide, a slide that you are very familiar with, again, more relevant than a specific number of 2.5% is basically on the one hand side, the trend. So a clear downward trend, which means credit losses over portfolio size are really decreasing significantly. That in turn means that asset quality is improving. And the second statement I would like to make, that during this period from 2019, 2020 till 25, we have the business has managed to remain extremely resilient throughout a number of external shocks that we had to deal with. Finally, let me take a quick look at funding structure on the next page. As pointed out, the strategy doesn't change. We have two principles. One is we want to be quite independent of any single source of funding. This means we will remain on the capital markets. And again, I think it's a great performance by the bank team to be able to issue a Tier 2 instrument independently. That's one. Secondly, main focus in terms of funding the business is also going forward to be deposit. Deposit costs are reducing a little bit. Naturally, this is our main focus also going forward to push costs down. In terms of liquidity risk and funding risk, there is no upcoming repayment over the next year. So from that perspective, we are set to scale the business going forward. With that, back to you, Antti, and to you, Adam, for Q&A.
Yes, thank you, Bernd. With that, we open for questions. Again, you can raise questions either through the chat by using the Q&A box, bottom of your screen, or via voice by raising your hand using a button also located at the bottom of your screen. While we wait for any voice questions, perhaps Bernd, we would like to start with a question to you. In Q2 2025, it's a question from Stefan Hirschhofer. In Q2, the interest expense were quite high with 11.4 million euro. Due to the significantly lower 3-month Euribor, I expected less costs here. Could you give us a rough split how much interest expense are the bonds, long-term deposits from customers, and short-term deposits?
Yeah, absolutely. And yes, I mean, overall interest expenses are reducing. They are also in absolute numbers below H2 level of last year. And also in terms of composition of the cost, I would want to make one or two statements. First of all, composition of the cost structure. Now, if you look at H1 in its entirety, this is 21, a little bit more than 21 million. The bulk of that is deposits. So 15.5 million roughly is related to deposits, which is an increase of around about 1.5 million compared to last year. At the same time, the volumes have increased significantly. So we actually see already from a relative price reduction of deposits by around about 38, 39 basis points compared to last year, a positive cost reduction effect of 1.7 million. But again, in absolute terms, 15.5 million roughly out of this 21 million are related to deposits. Secondly, we have around about 4 million related to the senior instrument on holdco level. That's the 80 million instrument that we have issued in order to replace the instrument expiring in 25. And then this is also one of the drivers in H1 this year, is cost related to the Tier 2 instrument on the level of the bank, a little bit more than 1 million in the first half. But again, this is a prerequisite in order to enable our growth. We're currently at 23% capital ratio on the level of the bank. So this is actually going to support future growth. And yeah, if I may continue, what is your expectation for the next quarters regarding the development of interest expenses? Well, I mean, we have these two drivers that we need to factor in. As deposit is going to remain the main source of growth also going forward, we expect interest rate levels to go down. We have to factor in that those term deposits that we needed to take on board over the last 1.5, 2 years, 24 months, 36 months, this is a gradual effect. So we will see a reduction, but it will not be a jump, but rather a gradual effect. this is something that actually, I don't know whether it's a good point in time to make reference to that, but just today we are going to revisit our interest rate deposits, and might well result in a reduction for new deposits that we take in. So a gradual reduction, and naturally our ambition is to push as much as we can. And ideally at some point also supplement the reduction by taking in products that enable us to take in less price sensitive or interest rate sensitive clients. Then the next one, if I may continue, Stefan Hirschhofer, an accounting question. The dividend of Lea Bank is not recognized in the P&L. Is this only a cash effect? Why is that so? Can you please explain? Why is that so is a very good question. This is basically the logic of IFRS in that respect, but there is an element of logic. So what is actually happening is that the pro rata profit of an associate is reflected in our P&L. So this will be around about 2 million this year. And this is why the dividend payment is not again reflected in the P&L, otherwise it would be double counted. What is actually happening is that the dividend payment economically is to be seen as a cash repayment that reduces the amount invested. In the particular case of Lea Bank, this means that we have invested some 23-24 million roundabout, and we get back 4 million cash. This means that the investment, the carrying amount of the investment is reduced by 4 million. But it is obviously fully cash effective. So we have two effects. One is pro rata profit from the net profit generated by Lea Bank, and the positive cash impact from the dividend.
Then we have a question still from Stefan Hirschhofer. I will combine a few one here. There are questions about, are you confident to reach the target for CapitalBox business in whole year 2025? And the both quarters were negative in profits. What will you do to change this in second half? If I take this one, we can see that we have massively decreased the losses and we are almost at the break-even level in CapitalBox. There is not like a one magic silver bullet. We are continuing the same work of reducing the impairments while at the same time growing in a pretty high numbers. The team is making the processes much more solid at the moment, much more effective. We have started factoring business in a few countries, which you don't see yet in the numbers since it takes time to grow the portfolio. You can see some of it in the numbers, but obviously the portfolio growth needs to first be there in order to generate the income. So on CapitalBox side, having the second half on quarterly level basis profitable, those are the measurements to go forward. And a bit on the same note, there's a question from Peter Irblad, the same question on the CapitalBox, but then also on the wholesale banking positive EBT on how can we go to between 4 and 5 million in wholesale banking. That hard time to reconcile that. There are a couple of dynamic things that we believe that we are going to between 4 and 5 million. First aspect is the payment business. We have now signed customers earlier this year, and before we can really grow up the volumes, you can already see a significant fee income. Before we can grow up the volumes, you have to test, you have to monitor, you have to build up the business, and it takes a bit time before the big volumes come in. And now we already see the fee income, and it will continue. The same dynamics goes for the portfolios that we have in wholesale banking. You first grow the portfolio, you have to take reservings in the beginning, and after that, the interest starts ticking. So now the portfolios and the net AR have been growing quite well this year. So we expect the 4 to 5 million euros EBT to be reached. And also, like Bernd already said, we have invested in personnel, especially now in wholesale banking unit, growing up the team. in the beginning of the year. The team is now in place. We don't expect that we are growing the team there massively. Now it's time to scale up, which the team is ready to do.
Yes, maybe I continue with another question raised by Stefan Hirschhoff, and maybe then we move on to other participants. There was a question related to balance sheet position. Can you please explain the balance sheet position, other financial assets with 50.6 million in Q2? What are the main drivers for the increase? The increase, to put it into perspective, last year the position was, or end of year, I should say, was 27 million. Now it's 50 million, so delta is 23 million. There are basically three factors behind that. One is portfolio sales, so receivables from portfolio sales. The second one is strategic partnership in the consumer banking business. And the third one is related to the reduction of number of legal entities and entities that have been sold. There are two components, again, within this total amount of around about 10 million, a little bit less than 10 million related to entity transactions. That is cash receivable that, by the way, meanwhile has been settled in full, so it's no longer on the balance sheet as per today. And the other one is the capitalized expected cash flow from an earnout model related to entities. And then maybe one more nature of fee and commission income, newly introduced fees, and what are the growth plans? Should I continue, or do you want to take?
Oh, you can continue if you want, yeah.
Yeah. Okay. In total, it's 5.4 million, and the absolute comparative number from last year is 21,000. So this is really something. A game changer is a big word, but it is really strategically meaningful and a reflection of, in my view, at least the appropriateness of the strategy of both businesses. So that's the consumer business on the one hand side, and also the wholesale banking business. Now, what is it in detail? 1.1 million out of that relate to wholesale banking, more specifically payment related fees. I think Antti has outlined the strategy in one of the previous meetings. The idea was to capitalize on what we have developed, the payment infrastructure, the ability to provide payment services in a number of technical manners, but also a number of currencies to external partners. This is what is happening, and this is generating 1.1 million in the first half. And the second one in the consumer business, that is a strategic partnership with a client in Poland, generating around about 4 million. And then there's a residual of 3.7 million. And then we have a residual element related to platform related to the sold entities. We are still providing services that accounts for 600,000 roundabout. And yes, all of those three revenue sources are meant to stay. So obviously it's not a guarantee and not a promise, but it's not a one-off.
Good. Then we have a one on Stefan Hirschhofer on the interest expense, if you take that burnt also.
Yeah, I think I've covered it already. The question is 8.1 million deposit expenses in Q2 compared to 927 is 3.5%. Is that correct? Yes, that is essentially correct. We are, and as pointed out, currently we are paying for around about 2.5% to 3% for new deposits. That is already 100 to 150 basis points lower for new deposits than last year. And as also pointed out, maybe not something that, this is an idea, it's not an announcement at this stage. It's not unlikely that for new deposits, these rates will drop further, but we just need to factor in that this is a gradual process of melting down of interest expenses.
Yeah. Then we have a question from Jonathan Kogan. Growth seems to be slowing. How do you plan to accelerate momentum while keeping impairments under control? Wholesale is showing nice growth, but also higher impairments. What should we expect going forward? Well, we should expect going forward to deliver the guidance to start with. And what we can see now, for instance, on consumer side, what already Bernd was explaining, that we have a meaningful fee income coming compared to last year, and that is a strategic choice we have made. So it takes time to build that business up, but we see a big growth momentum. There are also a few other factors. One is I already mentioned the German credit card business, which is now taking well off. We have to remember that it starts from almost zero when we have zero credit cards and you start building that up. The sales is now in really good level. The previous business we have had there on the microlending side, we don't have that. We have changed completely to credit cards now. So that's also a business line that we expect a growth in the future, just to name a few ones. Wholesale, yes, showing a nice growth, and like I expect the higher impairments, we have to reserve already in advance for possible impairments, which we don't have any at the moment. So we can expect going forward, especially now this guidance and keeping the growth going forward.
Good. I believe we have an audio question from Julius at NuWays. Go ahead, Julius.
Very silent audio question.
Can you hear us?
Yes, we can.
Yes.
So this is Roni Peuranheimo from Inderes first. Hi. So maybe about the guidance still, it seems somewhat cautious for H2. So should we expect any additional cost inflations coming in H2, or what can you tell about the impairment loss trend for the rest of the year?
Bernd, do you want to take this one or?
Yeah, I can. I mean, I think what you're probably doing is you're extrapolating 14 million net profit to the full year, which gets you to 28 compared to 24 to 26 already improved guidance. Now, I think there are three factors. One, what we are interested in is really developing a mid to long term clear path of profitable growth. This was the rationale behind the 4-year of EBIT guidance. Is the rationale behind this 25 to meet in the middle guidance for this year and the 30 million next year. I don't think that there is any particular expectation that we have to see a deterioration in credit losses. That is not the message. But at the same time, we don't want to think it's appropriate to adjust guidance metrics each and every earnings call. We might look at that later, but again, it's not a promise. Secondly, growth is an ambition. Investment in growth can come at the cost. So for instance, we want to make sure that even if we were to engage into new initiatives, also acquisitions, for instance, that come at the cost, we wouldn't have to carve that out from a guidance, but really make sure that we have room to move. And this is how we look at the business going forward. And so I still think it's ambitious and realistic, and let's speak in a couple of months on how we look at the full year. But I think the key message is we are definitely comfortable that we will comfortably achieve the 25 guidance.
Okay, maybe next question from Fredrik Jasho, NuWays. Can you elaborate a bit on the Lea Bank stake? So first, do you plan to increase the stake further? And second one, can you reiterate maybe the rationales behind the acquisition and elaborate a bit on current and future cooperations that you see with Lea Bank?
Yeah, if I may take this one. We are happy with the stake we are at the moment. Of course, cannot comment on any future possible sales or purchases. We are happy where we are at the moment. We see Lea Bank from two different angles. First of all, as a financial investment, it's already been really good investment. We are happy with that part, but that's not the only reason we invested in Lea Bank. We see strategic importance in Lea, and we do see that the segments that Multitude is operating in and where Lea is operating in are not overlapping. So Lea Bank is giving out more higher ticket in size consumer loans with a bit lower yield. We are not in that business segment than Lea Bank is, and we are really well working on different segments in parallel. And we can see that there's still possibilities on product cooperation, on cross-selling. People have different needs for different loans. Lea is really good in what they are doing in that segment. We are really good in our own segment, and we are trying to find partnership models, synergies on cross-sells, referencing, etc. There are also other opportunities. But for now, we are really happy with the investment in Lea, really good financial performance. The bank is really well run. We are happy to be the largest shareholder of Lea Bank.
But do you have current projects with Lea Bank together, or are you still looking for opportunities? Is there already a project or something going on? Can you comment on this?
We are in really close cooperation discussing different options with Lea, but we don't have anything we could now go public that especially this product is now live.
Okay.
This is Roni Pernhema again. Maybe a recap, if you could give, have you sold any meaningful parts of your loan portfolios recently that would kind of affect the margin or impairment loss dynamics going forward?
Bernd, do you want to take this one? So the question, have we sold any meaningful portfolios? So no, we are continuing the same strategy that we have had, that we are keeping our balance sheet in really good shape, that once we have NPL loans, we are selling them into the market. Of course, we first collect them ourselves, so our collection strategies we are focusing on all the time, making them better. So this is one thing, and also on the impairment loss perspective. So it's not a thing that has happened over the next on the previous few quarters. You can see what Bernd was showing in the materials in the latter pages, that the trend on impairment loss is going down, has now been going on for a couple of years, really clearly, even more than a couple of years. So this is the reason that why we see the impairment losses going down. It's a long-term trend.
And maybe just to add, over the last couple of years, and you will recall this slide, which shows the improvement of asset quality over time. I think there are two main drivers. One is the qualitative improvements in underwriting, internal processes, collection, all that. The other one is the portfolio composition. And in all businesses, the strategic ambition was to establish a transition towards more recurring type of revenue and lower risk classes. Now, if we can achieve this target by selling portfolios, selling entities, outsourcing this type of shorter, higher risk loans, then we will continue doing that. But the overarching principle is that we focus on recurring products, on recurring revenues. This is also the rationale behind what Antti said earlier, the new product established in Germany. Naturally, the expectation is that long-term recurring credit limit, credit card type of product support the strategy of reducing or keeping credit losses on a low level. And portfolio sales, this is something that happens all the time. I mean, this is part of the business, to go for tenders, sell portfolios, also sell entities in the pursuit of the ambition to create a leaner organization. So it's not a strategic change; it's more an operational, tactical change.
Okay, this is Frederick from NuWays again. Maybe a broader perspective. I mean, the wholesale banking and also the SME banking is already profitable or is close to being profitable. What kind of steady state margin can we expect for both businesses, and what level of revenues need to be achieved for these margins?
That's a very good question. Antti, you have not said anything yet, so I start and you interrupt me, right?
Yeah.
Okay. On steady state, I think the really great performance of the wholesale banking team is to establish something that is net profit accretive in the first year, and that at least based on our ambitious plans, will generate 4 to 5 million net profit before tax in the second year. And at the same time, growing the portfolio at 3-digit million each year. So what does it mean in steady state? I don't know yet. Naturally, the ambition is, and that's the logic behind all business units, to make a meaningful contribution to the overall target, and that is the net profit guidance. Wholesale banking is doing extremely well in getting us there, based on what I just said. On CapitalBox, I think similar answer, whether unfortunately it's a good one from your perspective or not, but we are now about to break even, and that is the ambition for this year. Antti has given you the numbers from 6.5 million to 1.5 million negative profit before tax contribution, whilst growing. Credit loss is much better than they were. Organization is more scalable, lower fixed cost, also in absolute terms, by the way, lower fixed cost levels. So that should enable us to scale. And then I don't see a limitation for the scaling momentum for either of those businesses. So as soon as all those businesses make a positive net profit contribution, I think we are fine for now. Antti, please.
I think this is a good answer. We have a question from Mark Luthi asking about share buyback program, which is going on. Do you intend to increase? We don't have any at the moment. Any new programs planned will be then announced should we have one. Then Harald Hoff is asking from MWB Research that could you provide a bit more details on credit card in Germany, that how is it working, etc. So this is a Ferratum branded credit card working with MasterCard, like all of the Multitude cards at the moment. So this is a fully owned operation. In Multitude, we have the payment infrastructure in our mobile bank as well, and including credit cards, debit cards. So we are having this service now for the German customers, and we are expecting the customer intake to grow. We see this as a good product which have traction on the German market. So in a way, pretty traditional credit card, fully operated by ourselves with the MasterCard brand. Then we have a question again from Mark Luthi, that now when the company's headquartered in Switzerland, that are we considering a listing on the Swiss Stock Exchange? And we don't have such plans at the moment. We are now listed in Frankfurt Prime Standard. Any additions on that, Bernd?
No.
Okay. Good. Then continuing from Mr. Luthi is that do we expect any banking as a service partnerships? There is nothing that I would say rule out on that particular part either. This is important when we look now the partnerships in general, and there was questions about growth in the future. So we have 3 growth pillars. I have to remind of those: organic growth, which we have done for the last 20 years, and we have businesses in different stages of their maturity. We do have also partnerships, which we are working really hard on. The Polish example is a good one, and we expect new partnerships to be announced at some point in time. And also M&A, we have evidence, for instance, buying the Omniveta business last year for CapitalBox business. So those 3 business growth pillars and dynamics we do have. Then there's a question from Thilo Müller that the net profit guidance for 25, this we have between 24 and 26, and that we are coming really close already to 2026 guidance with Thilo's calculations. When do you have a higher? When will we have a higher guidance in 26 is the question in my understanding. We are now looking at the 2025 numbers, and we have the 2025 guidance. 2026 guidance will remain intact at 30 million euros, and when the time comes, we are then looking in the next year numbers closer to year end.
Maybe in this respect, if I may add, in a little bit less than 3 months from now, on the 13th of November, we will have a Capital Markets Day, and I think this will be a great opportunity for us to share our view on 26 in terms of financial performance expectation. And again, without promising anything, I think it could also be an opportunity to give a little bit of an outlook on how we see financial performance developing going forward.
Then we have a question from Daniel Brunner. Are you planning to enter new geographical markets in the near future? And congrats for the great results. Thank you, Daniel. We are not planning now to enter anything that we could announce, but we are happy with the current portfolio we have. But like I stated just a minute ago on these 3 different growth pillars that are organic, partnerships, and M&A. And should we see good partnership or M&A opportunities in the jurisdictions which we geographically are not now present at, we are ready to go. Our digital business model allows us to start and expand even quite fast in new geographical markets, should we have a right fit which we want to grab. Then there's a good question from Tilo Müller again. What makes you sure having a market cap of 1 billion in 28, and what net profit do you need that for a basis? To start with, that is our dream position, to be 1 billion market cap at 2028. We are not sure that we're going to be there. This is our dream, but we are confident in the management that we are on the right path. Well, the net profit needed for it depends obviously what the PE for the company needs to be, and we have calculated different scenarios, which I believe you always, all analysts and investors have also done. There are different ways to go there. I would say that we are telling more about the value creation structures or updating the ideas that we have and the strategy in the coming Capital Markets Day in November that Bernd was already mentioning. Then we have on the dividend question. Do you want to take this one? I think it's a bit premature already, but if you, Bernd.
Yeah, Geron Kruse, how will you determine whether the payout ratio for the 25 dividend will be close to 25 or 50%? Yes, this is something I cannot really comment too much on, and it's not clear yet. There are a number of factors: growth dynamics, equity requirement, investor expectations. So a number of factors. I think what is, from our perspective, super important is that we have this ambition and be very clear about the ambition of being a growth, value creation, and dividend paying company. And give us, please, some time to give an indication on in which directions shareholders will be thinking.
Yeah. Then we have a question from Peter Irblad, coming back to the CapitalBox growth question, that the quarterly net ARR growth has been still slow, and when we can expect an acceleration. I think the acceleration can be expected any time soon, and it's already accelerating. We have to remember that we are changing a bit on the product setup as well, and the product offering. Factoring product as one product is a new one, which we are still accelerating. This is one key driver, and that is kind of a business model which is rolling over every month. So it's a more shorter traditional factoring done in a really effective digital way. Then launching, and launching is perhaps, since it's already launched, but accelerating the secured lending business in CapitalBox, where we see a good attraction in the Nordic markets, and those are my high expectations on CapitalBox business to grow in the Nordic markets in the secured debt space, whilst maintaining also the good results in the unsecured lending model we have. And now we have all the tools there to accelerate the growth.
Very good. I believe that comes to the end of the questions. So thank you for all who have joined us today. Bernd and myself will be attending the German Fall Conference in Frankfurt on the 1st and 2nd of September. If anyone is attending, feel free to connect. And as mentioned by Bernd, a reminder that we will be publishing the 9-month results on the morning of the 13th of November, and later in the day host our Capital Markets Day, where we will as Ben mentioned, give a bit more flavor on 26. We will send out further details closer to the event. I hope to see you then. Thank you and goodbye.
Thank you. Have a good day.
Good day.
Bye.